During strong trends, the trend-following strategies will help you catch pullbacks. Strategy 1. Divergence plus support and resistance. As we already discussed, divergence is a strong sign of reversal, but we cannot trade every divergence. We need to identify potential reversal areas and wait for the MACD to create divergence around those areas. For this, we will use the concepts of support and resistance. We will first identify the support and resistance levels on a higher time frame. Then, wait for divergence on a lower time frame. Here is an example. We have the GBP-USD pair on the 4-hour chart. The price made an up move and then reversed, so we plot a level of resistance here. When the price arrives near the resistance for the second time, we expect the price to reverse downwards again. So, we switch to a 1-hour chart to look for divergence. Here is the same price action on a 1-hour chart. We see that the price made a higher high coming into the resistance level. But on the MACD, we see lower highs. This is a clear and obvious bearish divergence. It tells us that the buyers have lost momentum coming into the resistance. We have a confluence of a resistance level with divergence. This is a high probability trade. Therefore, we should look out for a sell trade. For our entry, we need to identify the lowest point between the tops on the MACD. These are the two tops. Here is the lowest point between them. We draw a line at that bar. Then we wait for the histogram to break below that line. On this bar, the histogram breaks below the line, so we enter a sell trade on the corresponding candle. As you can see, we saw a steep down move after our entry. Here is an example of a buy setup. We have the USD JPY on a 4-hour chart. This upside reversal helped us identify this support level. When the price returns to this level, we expect the price to find support and move upwards. So we switch to a 1-hour time frame and look for a bullish divergence. The price makes a lower low coming into the support zone. But on the MACD, we see a higher low. This is a clear and obvious divergence. It shows us that the sellers have lost their strength and momentum in this down move. So, we identify this as a high probability trade setup. Now, we mark the highest point between the bottoms on the MACD and draw a line. On this bar, the histogram breaks above the line, and it is a buy signal. So we buy here. As you can see, the price made an up move and touched the most recent highs. So this is how to use the divergence with concepts of support and resistance. Now let's look at the second strategy. Strategy 2. Divergence plus Bollinger Bands. Bollinger Bands are a very popular indicator that traders use to trade reversals. The theory is this: 90% of the time, the price is expected to stay within these bands. So, whenever the price moves outside the bands, we can expect the price to reverse and return inside. If the price moves above the upper band, we expect it to reverse downwards. Similarly, if the price moves below the lower band, we expect the price to reverse upwards. We will combine this analogy with the MACD divergence. But first, we will go over the Bollinger Band settings and change the length to 200. We will keep the standard deviation to 2. This gives Bollinger Bands on the 200 moving average. Here is a sell setup using this strategy. Here, we see that the price was in an uptrend. The trend was so strong that the price stayed above the upper Bollinger Band for an extended period. Now, we expect the price to move lower, so we look for a bearish divergence. Here, the price made a higher high, but the MACD histogram made a lower high. In fact, on the second top, we don't even see a green bar. This is a great sign that the sellers have grabbed hold of the markets and the price will follow soon. So a selling opportunity presents itself. For this strategy, our entry occurs on the first candle that closes back inside the bands. So this will be our entry candle. And as you can see, the price made a solid down move after our entry. Moving on to buy trade. Initially, we saw a massive down move that stayed below the lower band. The price spends a lot of time below the band. We know that the price cannot spend so much time outside the bands, so we are already expecting a reversal to the upside. Towards the end of the move, we see the price was constantly making lower lows, but the MACD histogram was plotting higher lows. This was a clear and obvious divergence. We have a combination of the Bollinger Bands and the MACD divergence. It indicates that the sellers have lost all momentum coming into the down move. The buyers are pushing hard, and an upwards reversal may occur soon. So we should look for a buy trade. Our buy entry occurs as the price closes above the lower band on this candle. As you can see, the price shot up after our entry. So this was a unique way of trading MACD divergence with Bollinger Bands. Now, moving on to the trend trading strategies. Strategy 3. EMA bands plus zero-line pullbacks. For this strategy, we will need 4 indicators. We need the MACD and the 3 exponential moving averages. All 3 of them are 200 EMAs, but with different sources. The upper EMA is calculated on the highs of the candles,